Welcome. In this video, can Swftcoin increase 100% from here? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. As a result of a careful technical analysis conducted on the chart, it is clearly observable that the current price movements are forming a classic chart pattern known as a flag. These types of patterns typically appear during consolidation phases that follow sharp, directional price movements in the market. Especially after a strong upward move, the price tends to begin moving within a narrow range, either sideways or slightly downward. This is where the flag pattern becomes apparent. In technical analysis, this phase is referred to as the consolidation period. Essentially, the market is catching its breath after a strong rally and gathering strength for its next move. The current formation observed on the chart suggests that the flag pattern indicates a temporary slowdown in the prevailing uptrend, but that the trend itself remains intact. The price is now compressing within this structure and is in search of direction. Such tightening formations often precede significant breakouts. In particular, tests of the upper boundary of the flag, accompanied by increasing volume, can signal that the market is preparing for a breakout. According to historical data and technical analysis literature, flags are typically viewed as continuation patterns, meaning that once the pattern is broken, the existing trend is likely to continue in the same direction. Since the price action is currently unfolding within an upward trend, a breakout from the flag to the upside is technically more probable. If the price breaks out of this compressed structure with strong momentum, it would be interpreted as a bullish signal by both technical traders and investors. In such a breakout scenario, the pattern target is usually calculated by projecting the height of the initial flagpole, the move leading into the flag, from the point of breakout. In other words, a price target equal to the length of the flagpole is expected. This implies that the price may see a significant upward move in the short to medium term. For example, if the price had surged 20–30% prior to the flag forming, a similar gain could potentially follow after the breakout. Additionally, a breakout to the upside can create a positive psychological and technical sentiment in the market. Investors who missed the initial move may view the breakout as a second chance and enter long positions, which in turn can lead to higher trading volumes and increased buying pressure. As a result, the price could break through resistance levels more easily and reach new highs. However, it's important to note that any breakout should be confirmed by volume. Breakouts that occur without strong volume can be misleading, and the price may fall back into the flag pattern. Therefore, it's crucial not only to monitor the breakout itself, but also the trading volume at the time of the move. If the breakout is accompanied by a noticeable increase in volume, this strengthens the technical validity of the move and makes continued upward momentum more likely. That said, relying solely on chart patterns isn't enough. Other metrics and indicators should also be taken into account. Keep monitoring the situation closely. When we take a broader and more detailed look at the chart, we can see that the price movements are quite striking and provide significant signals from a technical analysis perspective. In particular, the structure that has started to take shape recently appears to point to a well-known and powerful pattern, often used by investors to anticipate trend reversals: the inverse head and shoulders, also known as inverse H and S. The emergence of this pattern typically marks a potential turning point for assets that have been under pressure for an extended period, often moving within a downtrend. That's because the inverse head and shoulders is considered a strong technical formation, indicating that buyers are regaining control and that the asset is preparing to reverse to the upside. On the chart, the pattern consists of three main components: the left shoulder, the head, and the right shoulder. In the current scenario, the left shoulder has clearly formed, followed by a deeper pullback that created the head, and now we are witnessing the gradual formation of the right shoulder. This right shoulder phase often reflects a period of uncertainty in the market, yet it's also the final stage before a potential breakout. For many investors, this zone is a critical observation area, because once the pattern completes, a significant price move is likely. The most crucial phase of the inverse head and shoulders pattern is the breakout above the neckline, a horizontal resistance level drawn across the highs of the two shoulders. When the price breaks through this level to the upside with strength, the pattern is considered confirmed and valid from a technical standpoint. This breakout typically signals that the market is ready for an upward move and that buyers have gained full control. At this point, volume analysis becomes extremely important. A noticeable increase in volume during the neckline breakout indicates that the move is strong and sustainable. If the breakout occurs on low volume, it may suggest that market participants are not fully supporting the move, raising the possibility of a false breakout. Therefore, it's essential not only to recognize the visual completion of the pattern, but also to confirm it with volume data. The potential target of the inverse head and shoulders pattern is also quite clear. In technical analysis, the target price is calculated by measuring the distance from the bottom of the head to the neckline and projecting that same distance upward from the breakout point. This gives traders a concrete reference point for potential profit. Additionally, it's important to emphasize that these types of patterns have a psychological impact on the market as well, not just a technical one. The completion of this formation can instill confidence among market participants. Buyers tend to enter more aggressively, while sellers become more cautious. This dynamic paves the way for a stronger and more stable trend in the breakout direction. To summarize the current chart setup, the inverse head and shoulders pattern has taken shape clearly, and the price is now in the process of completing the right shoulder. If the neckline is broken to the upside with strong volume, then according to technical analysis principles, the price may rise by a distance roughly equal to the depth of the head. This suggests that a significant upward move could be triggered in the coming days or weeks. Patience is key. We must wait for a confirmed breakout above the neckline. Upon a detailed examination of the chart, we can observe a clearly defined long-term downward trend line on the RSI indicator. This descending structure has effectively acted as a barrier, limiting RSI's upward movements and suppressing bullish momentum over time. Each time the RSI approached this trend line, it reacted as if hitting a wall, reversing downward and signaling a weakening in price strength. This type of falling trend line is a significant structure that technical analysts pay close attention to, as it serves as a structural resistance level that directly impacts market momentum. A breakout of this RSI trend line is not just a minor technical event, it also reflects a shift in market psychology, indicating that investor sentiment may be beginning to change. At the moment, the RSI is once again making a move toward this descending trend line, but it has yet to break above it. This suggests that price action is still under pressure. The RSI is at a critical juncture. If the trend line once again acts as resistance and pushes RSI lower, we may see a corresponding pullback or correction in price as well. On the other hand, if the RSI manages to break above this downward trend line, and especially if it follows up with a retest of the trend line as support, this would be a technically strong and highly bullish signal. Breakouts like these on the RSI often precede powerful upward movements in the price chart. A trendline breakout on the RSI can be interpreted as a shift in momentum in favor of the bulls, signaling that buyers are gaining control and the market is starting to build strength. Furthermore, the RSI has now crossed above the 50 level, which is another positive technical sign. In traditional RSI interpretation, readings below 50 are associated with weaker market conditions, while values above 50 indicate a stronger, more decisive market where buyers are in control. So currently, RSI is not only testing a major resistance trendline, but also positioning itself above the 50 threshold, potentially setting the stage for a strong bullish signal. At this stage, the most important detail for investors to watch is whether RSI can successfully break through this trendline. If it does, it would serve as a strong leading indicator that price is likely to follow with an upward move. And if the RSI then retests the broken trend line and bounces back up, it would be considered a very strong confirmation of a trend reversal from a technical standpoint. In summary, there is a well-established descending trend line on the RSI, which has served as a significant resistance level. Now, RSI is approaching a potential breakout point. If this breakout occurs successfully, it would be a clear indication not just of RSI breaking out, but of an overall shift in market direction. For that reason, this technical setup on the RSI is highly critical and could prove to be a key factor in determining future price action. Remember, RSI and price typically move in tandem. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. See you soon.